Hey, it's that time for a new video, and it is Thursday, putting them out every week for you. So this time we're talking about something that's interesting. Can the economy handle super low interest rates like we have right now? Tune in and let's find out. Hey everybody, Eric here, and we're going to start talking about these super low interest rates that we're having and a real interesting proposition. What happens if the interest rates aren't that great for us? What happens if it actually hurts the economy in ways? And I'm going to go over some things for you today, and we'll actually ponder a few things. So let's get to it. So when you're looking around, the buyers out in force. They got more buyers right now than we have sellers. Interest rates are super low, so that's driving a lot of buyer activity. And the sellers are asking more and more for their houses when they put them on the market. Before we get too deep into it, let's talk about something real quick. I'm sure you've all heard of Redfin. Well, they just came out with something last week, and they're talking about the price of homes. Well, according to Redfin, the median prices of homes now is $311,300, which is the highest price that it's ever been. Also, according to Redfin, prices normally peak in June. This time they're not seeing that they're continuing to rise through July, and because of the pandemic, we had a late start to the year, and they're expecting to continue to rise for several more months. So still not a great thing, especially for those of you who are hoping that prices will start to settle down, the multiple offers would stop. They're saying that it's going to continue on for a little bit. Remember, that's one company's opinion. We'll see what happens as things go on. Now hear this. This is the big one. Average interest rate for this week, 2.98%. That is the lowest rate in over 50 years. 50 years. This time last year, the average interest rate was 3.81%. So, huge difference. And that's a huge difference in your buying power. For every 0.1% in interest, that equates to $5,000 in buying power. So you have a $50,000 advantage in buying power from last year. So even though houses went up, your payments are less than they were last year, purely because of interest rates. Now here's something that's cool. Did you know that 50% of Americans, that's half, owe 4% or more in interest rates? So half of Americans have an interest rate of more than 4%, which means there is a lot of room out there for people to refi if their credit's good. This has created a refi boom, and banks are overwhelmed now. So overwhelmed that I got confused last week. As a matter of fact, last week I put out a video and I had to correct myself because someone called me up and said they had a 2.25% interest rate. And I went like, 2.25%? It's time for me to pick up the phone and call the bank. So I went to the website, went to my banks, and went like, let's see what the current refi rate is. You know what it was? 4.5% for refi. I'm like, that don't even make any sense. And then I remembered something. I took a class on banking and mortgages and stuff. And whenever you see a bank do that, there's a reason. That's because they've become overwhelmed and they don't want any business. Don't want business. That's a strange thing to think about. So whenever you see a bank and they're not competitive and you're like, wait a minute, this bank over here, they'll do it for 3%. You want 3.5, 4%? That doesn't make any sense. It's because they don't want business, or they want business in a certain range. because it has something to do with the secondary market. And sometimes they're overwhelmed and they don't want the business. They can't service it. So that tells me they don't want the business right now because they can't service it, because normally my bank has very competitive rates. The fact that it was 4.5% tells me, knowing what I know about the business, they did not want my business. Okay. Hope they don't want it for too long, because at the current rates, I gotta go and look. Oh, quick little side note. Those 2.25% do exist. But there's some caveats. Some things have popped back into the picture that haven't existed for a very long time. Things that we haven't heard about in so long that I haven't even seen them in my real estate career. And I am rapidly approaching my 7th year in real estate. I had forgotten about these things because it's been so long. Because not even in my entire real estate career have I seen these things. They've been so ancient. Points. So yeah, there are banks out there that are doing 2.25% with points. So one the other day, they're doing 2.25% with a 1% origination fee and 3 points. So up front, you owe them 4%. Plus all the other closing costs. So that's with a refi or buying a house. So can you imagine on top of your down payment, if you have a down payment, all your closing costs, if you have them, you'll another 4%. That'll hurt. But long run, it may save you a lot of money. It's 2.25%. Who knows? You gotta really juggle that. Run the numbers. Talk to your real estate professional and run those numbers. For if you're staying in the house for a long time. 2.25%. Gotta really run them numbers, but it's a lot. Let's pretend you have remember we just talked, average house is 311. 3 times 4. Got some math in public here. I do believe that's about $12,000 just for the points and origination fees. That's a lot. Okay. Now, one of the legitimate banks out there, United Wholesale Mortgage, they're the second largest mortgage lender in the United States after Quicken Mortgage. Right now, they have a loan product out there for 2.5%. And that's on a 30-year fixed. So it really is out there. And a lot of the banks are saying, or the mortgage gurus are saying that the least that the mortgage percentage will ever go down to is going to be 2.5. And I'm going to say that for legitimate banks like this. To be honest, I've never heard of this bank, but yeah. So they're supposedly the second largest mortgage lender in the country. The reason I say that, even though like the government is lending the money for free, it has to do with the costs that are built into it. I mean, it's almost free money, but free isn't always free. They have costs, they have employees and they have to service you and they got to make a profit. They have to have a little bit. They got to have a yacht. The yacht may have gone from a 120-foot yacht to an 80-foot yacht, but they still have to have their yacht. They've gone from a G7 to a G5 for their plane, their private plane, but they still have to have something. You have to give them something. So let's get to the crux of everything. Why is all of this bad? 80% of all the homes that are sold every year are the resale homes. Those are the homes where you go to the MLS, the multiple listing service, and you go out with your realtor and you're spending the day looking at houses and making the appointments and doing all of that stuff. Well, if people are getting 2.98% loans and they had a 4.5% loan, a 5% loan, and they've been sitting on the fence, and they can now save hundreds of dollars a month, they just refi. They take money out. Well, they take that money out, they refi. I can now fix my house up and make it a dream house. People move because they want something new. They want something different. They can now make it new and they can make it different. And then they can be in it for the same or less than they were paying, and definitely less than they would be paying if they upgraded to a new house. But wait a minute, you needed their house. That was your move up, your come up. See, they're not going into their come up, they're staying in your come up. You get it? So if they're not moving, you ain't moving. That's the problem. When they stay put, there's no houses for you, which means the few people who are putting their houses on the market can demand more for their house, which causes even greater inflation. So, well, we've been talking about new houses. Well, I have a new house. If these house prices are increasing, I can increase my price. If these prices are increasing and there are no more houses because people are staying in their houses because they got 3% interest, I can raise my price. You see the cycle that goes there and what it can lead to? And here's another thing. Because of these low interest rates, because the government has lowered the interest rates, so now the 10-year treasury is 0.6%. At the start of the year, it was 1.9%. So what does that have to do with me? That's what you're saying. What's that have to do with me? Well, you're trying to save for retirement somehow. What happens if you have a pension? Well, your pension, they have to invest someplace, usually invest in bonds. Well, bonds produce less. More of a chance for the pension to not meet its goals, which means it gets taken over by the government, which means your pension that may have suited you comfortably is now a half or a third of what it was. Let's pretend you have a 401k, which is what most people have who do invest for retirement. You're now, unless you're investing in stocks, those little bonds and money market funds that you're investing in, they're not producing anything. Okay, what are stocks producing now? Not as much. So now your retirement's not doing well. What about your kids' college fund if you have children? It's not producing anything. So where are you going to come up with money for your kids and your college savings? That's not going to do anything because, especially those last few years, you're going to pull it out of everything and put it in bonds, so it's going to be safe. Those bonds are producing less than 1%. They're eaten up by inflation. Let's say you're retired. Most of your money's going to be in bonds. So all of this is cyclical. It comes back. Now, all that money you have tied up that for your retirement is being eaten up by inflation. There's no growth there. See how this all ties in? And then what about all of the industries that rely on people moving on? We have entire economies depending on people selling their homes and people buying their homes, or people selling their homes and bulldozing that home and building a new home. Think about in California where they just buy a house, bulldoze it, and build a new one. Well, if someone fixes that house up, no one's bulldozing that home and building a new one. Now, the future, who knows what happens? If everyone's staying in their home, new industries could pop up. Lowe's could have a renaissance because everyone's fixing up their homes now. Do they do it themselves? Do handymen and contractors have a renaissance? Do things change? I don't know. But in the short term, some things are going to change. And as everyone starts staying in their homes, we don't know what's going to happen. Because it's a brave new world. Because people are staying put. And they're not moving like they used to. It had gone from 4 and 5 years and people are staying in the homes. 7 years. And before the pandemic, it was 10 years. Who knows what it's going to be now? Only time is going to tell. And we come out of this when God help us as soon as possible. We'll find out. And we'll see how many people have refied. Because the first 4 months of this year, we had 2 million people do refis. This is before the pandemic really even hit. We had record numbers of refis. That was twice the number of refis there were last year. They don't have the numbers in yet for the second quarter of the year, but right now it is looking to be out of this world. So we're going to have to see. So I hope some of this helped you out, understand what's going on in the market right now and how these low interest rates, how they're helping buyers buy homes, how they're fueling competition, and how it's leading to some more interesting issues of sellers who are staying in their homes now because they're refining, sometimes taking money out, getting that house fixed up, creating the dream house that they've wanted, saving some money, and then staying. So now they don't have to leave, which leaves fewer houses for buyers, which is creating a new cycle. Let's see what happens. And if you like the content that I'm putting out, subscribe, like, and comment. I love your comments. Thanks, everybody.